Welcome back, everyone. Michael here with Offshore Citizen, and today we're going to have an investment topic to discuss, which is what I call sequenced diversification. All right, so I've had a number of people over a period of time contact me, and they want to know about protecting their wealth, right? One of the ideas is, of course, we have the wealth building phase. We have the idea of reducing your taxes and keeping more of what it is that you make. Then we've got wealth preservation. We'll of course discuss, asset protection and things like this. Today we're specifically going to talk about protection against risks, such as, risks in the market, right? Market volatility. And the most common thing that we hear about in this sense is diversification. Now, diversification really is, I would say, a protection against two types of things. The one is protection against basically randomness, okay? And that's the easier one, I would say, to protect against, right? The second is the protection against ignorance. And I'm generally not a great believer in diversification as a protection against ignorance. It's kind of, not necessarily so great. I think there's some better strategies, but against randomness, it's almost vital. So let's talk about why that is, and then I'm going to get into what the conventional strategy is that most people talk about, and how come I think that's a really horrible strategy for most people, and what is, in my opinion, the best way to go, which is this thing that I call sequenced diversification, okay? All right, what we have is, imagine you went and you bought a house, okay? So your house is an investment. We're saying in this case, let's pretend it's a rental property, right? Now, you might buy the best rental property. You may have the best due diligence. You may have the best cash flow. You may have the best location. You may have all these different things. And then the neighborhood catches on fire and it gets wiped out. Or you end up with an economic downturn in the area and all of a sudden your investment is worth a lot less. Or there's some sort of a natural disaster like a hurricane or something and you're not good. Now, of course, hopefully you have insurance in cases like this, but the reality is with a lot of investments, there's some degree of uncertainty. And you can only rely on certain numbers. For instance, your vacancy rate. You may say, okay, my vacancy rate is typically 5%, 10%, whatever the number is that you happen to pick. Well, that's only true over a large number of properties, right? It's not necessarily true over any given property. Any given property could have an extremely high or an extremely low vacancy rate. And obviously management has something to do with that, the quality of the property, a bunch of these different, the price you charge, etc. Anyway, the bottom line is you have this degree of uncertainty. It's the unknown unknowns. You have black swans, you have all this kind of thing. And you want to be able to protect against that, okay? So the best way typically, or the easiest way maybe, to protect against it is to diversify. So when you have, let's say 10 properties as opposed to one property, the likelihood that something's going to go wrong with all 10 is much lower than it goes wrong in one. If you're in 10 different locations, the likelihood that 10 locations go bad as opposed to one location going bad is substantially lower. When you're in a single currency versus multiple currencies, the likelihood that all those currencies go bad is lower than the chance that one goes bad. Now, keep in mind, when we're looking at this, there's a few assumptions here. One is we're assuming, and this is a generally safe assumption, that we suck at making predictions. Okay, it's just like humans' ability to predict accurately is garbage. We consistently fail, which is why the best people tend not to be very much on making predictions, and instead they go based on current realities, which is a whole other conversation. The second thing that we're paying attention to here is we do have to realize that typically in the process of diversifying, you're generally going to give up yield for increasing security, okay? And why is that? Well, let's say you happen to be able to pick, and this is a very difficult thing to do, but let's say you can pick the one best performing company on the stock market this year, okay? Well, if you diversify into 10, automatically your returns are going to go lower than that one. So you're doing this trade-off here, right? And this is why I think one of the reasons why a lot of the diversification is nonsense, okay? Because what ends up happening is that you end up diversifying into areas you don't understand from areas that you do understand. And understanding has a lot to do with not only reducing risk, but also increasing returns. And so you have this trade-off where you're getting a negative result in both sides by spreading wide, okay? So this is where we're gonna get into what is, in my view, a much better way to go. And we're gonna talk about a very specific example from a very, very famous investor who does very well. and how he does it, and why what most people are taught by the financial services industry, who are basically financial salespeople who suck at investing and have no idea what they're doing, there's a difference that comes out in there, okay? So what you will hear frequently, so what we have is you can ask, and I remember a client who does very, very well, they have a lot of assets, asked me, I don't know, maybe a year or two ago about, okay, how would you protect it? How would you, and it's like, okay, well, in theory, because you don't know what's going to perform well, you would be diversified between geographies, you'd be diversified between asset classes, you'd be diversified between currencies, right? This would be kind of the three main things that you would say, okay, we're going to try and diversify across. And if you're highly diversified, the likelihood that you will experience a catastrophic loss is extremely low, right? Because you would have to have a system-wide collapse. And usually, even if things go down, there's a time for recovery. Whereas if you were in a single asset, particularly something like a single company or a highly leveraged piece of real estate, you could lose it all, right? You could go to zero. So you want to be in a position that you can't go to zero when we're talking about like wealth preservation, right? Okay, so what is the conventional model for diversification? The conventional model says, hey, listen, you should basically divide your portfolio up, and it's usually based on asset allocation, based on a theory usually built around asset classes. Okay, so it's not usually what it is that I mentioned, where I'm saying, okay, great, you have 10 houses instead of one house. That's not usually what they're talking about. They're not usually saying, hey, listen, let's buy 10 funds or 10 stocks rather than a single one, right? Usually what they're saying is okay, you want a certain percentage in bonds, a certain percentage in stocks, a certain percentage in, precious metals, etc. Okay? That's normally kind of the approach we take. And there's different views on this, right? Kind of a very classic asset allocation mix would be, say, 50% bonds, 50% stocks. That was one of the ones that was discussed in The Intelligent Investor by Ben Graham, if you want to go and read that. Very good book, by the way, very good book. If you look at Ray Dalio, who's, perhaps, the king of asset allocation and diversification, if you read the loose variation that he gave to Tony Robbins, it's long-term bonds, then you have some short mid-term bonds, then you've got some stocks, then you've got some gold, then you've got some other commodities. And he has taken a different approach, which is based on something called risk parity. Risk parity is based on basically having counterbalancing volatility. Okay, so the underlying principle, and maybe I'll do another video on risk parity, so I'll kind of skip through it here, but the underlying principle is that if you had 50% stocks and 50% bonds, and bonds and stocks tend to be inversely correlated, which is not totally true, but it's often true, then if the volatility of the stocks is 3 times greater than the bonds, which is basically what Ray will say, then if the stocks go down 3x and the bonds go up 1x, then I'm talking about the ratio between them here. So let's say the stocks drop by 30%, the bonds go up by 10%, then you didn't actually equal out, right? So that's kind of his argument. Again, maybe I'll do a video on risk parity in the future and kind of explain kind of some of the more nuanced pieces of it. But anyway, the bottom line is it's based on volatility. And it's based on this concept of what he calls the all seasons portfolio. So basically you have different economic seasons where there are different economic conditions, and these affect different asset classes differently, and so you want to be in each of these asset classes, okay? So I think that if you were to go and sit down with a financial advisor today, what that financial advisor is typically going to say is they're going to say, okay, great, let's take your portfolio, say it's just for random numbers, $1 million, and there's going to be X percentage in bonds, X percentage in stocks, X percentage here, X percentage there. I think this is a very bad way to do it. And part of the reason is best explained, I think, by looking at the Yale portfolio. Okay, so Yale has an endowment fund, and it's managed by a very successful investor. It's probably the premier endowment fund for universities, etc. A lot of others look to them and try and copy them. And for many, many years now, they've averaged, I think it's around 21%, something in that range. And right now they're quite heavily over the last few years in private equity. And what it's done is it's created a wave of these endowment funds trying to go into private equity. And this is precisely the wrong mindset and the wrong thing to do. okay? Not because private equity is bad, but because they don't decide to go into an investment based on, is it private equity? What they do is they look for good deals and they invest wherever those good deals are, and it happens that they seem to find the good deals right now or over the last number of years in private equity, okay? So this really illustrates kind of the point, is that you don't diversify by saying, oh, I'm going to put X percentage of my portfolio in this asset class and Y percentage in that asset class. Instead, what you do is you go out and you look for good deals, and in the good deals, then you're going to diversify between them. And this is going to come, I'll get in a second, into what I call a sequenced diversification. But this is inevitably, your metric shouldn't be, oh, hey, I have to put, let's say, 30% into bonds, in which case you may put assets into a bad investment, or hey, I need to put 50% into stocks, which may mean you end up, you're trying to allocate and you're allocating into a bad place. This is a dumb idea. It's a horrible idea. Instead, it should be, okay, I'm maybe going to set a maximum. I'm not going to put more of my money in public market securities than 60%. I'm not going to put more of my money into real estate than, whatever, 60%. And interestingly, when you start to set these limits for yourself, you're going to find the total can add up to more than 100%, because collectively, you may never hit that maximum, right? But you're setting a limit for yourself, knowing, hey, listen, I could be at risk of loss if I'm overly concentrated in one area. And so I'm setting a limit, no more than whether it's 30%, 50%, whatever the number happens to be for a given asset class, which I think is quite smart, right? Like anyone who's, they put 80% of their net worth in cryptocurrency, probably not a great idea. 80% of your net worth going into startups, probably not a great idea. 80% of your net worth into gold, probably not a great idea, right? Just because we just don't know what's going to happen in the future. We're just not very good at predicting it, okay? And so we want to be diversified, and so we're going to put some caps in place. Okay, so with that in mind, setting that stage, I'm going to give you what is very practical for pretty much anybody, the sequenced process of diversification. So the first, and this is a wealth building plan in general. So the first thing is pay off consumer debt. Okay, so the basic idea is, hey, listen, you want to be nimble, you want to have access to credit, you don't want to be in a situation that if things end up tough, that you have extra bills. You're basically pulling down your monthly nut, and you're resulting in having higher cash flow monthly, but it's guaranteed rate of return. Okay, so you have to understand, if you're paying 12% on some consumer finance or 24%, then when you pay that off, that's a guaranteed risk-free 24% rate of return. It's very difficult to get that, right? So you should pay that off right away. Now, my definition of consumer credit is about 7% or greater. So I'd say pay off anything that is 7% or greater. Anything lower than that, then you start to say, well, the value of the credit may be making me money as opposed to losing me money. So the opportunity cost, you may be better off to keep it, such as, you can get mortgages today for 2-3%. And, why would you not have that money, right? So we're not saying get rid of all debt, but we're saying if it's high interest debt, where realistically the interest could add up to being more than the market is going to yield you, then get rid of that debt. Okay, so you do that. That makes you nimble. Great. If anything goes wrong, you're in a situation now where you have access to credit. Perfect. Second thing is you want a cash reserve. My recommendation would be your goal is to build up somewhere around 6 months of cash. And this means as your expenses go up, your cash reserve is going to go up. This means that you could make no money for 6 months and you're not going to lose anything. Now, as you get more wealth, this may go up as high as 24 months. I would say that when you're talking about holding that much cash, unless you're holding it specifically to wait for the next investment, I wouldn't consider that part of your reserve fund, I guess is what I was saying. I'm not saying that you can't have a higher cash allocation than that. You can have a much higher cash allocation, but don't have that as your reserve fund. Your reserve fund is money you never, ever touch, okay? Now, that money is set aside, perfect. What's next? You've got your reserve fund, you paid off your consumer credit. Now, your next thing is you want to buy collateralizable assets. And collateralizable assets are going to come in one of two forms, okay? They are either, in theory, it could be 3 forms. I'll list the 3, but the one I would knock out. So dividend participating whole life insurance policies or real estate are the first 2, right? Particularly a primary residence. The third that you could have is some sort of bond, but generally speaking, bonds today, the interest rates are just too low. I just wouldn't have a high allocation. But if there was high interest bonds, you could consider it in this mix. Now, I'm not saying high interest, I'm saying extremely low risk bonds. So let's talk about what collateralizable asset is. Collateralizable asset is an asset that I can easily walk into any bank and I can borrow money against it like that. Why do I care about this? Because my rate of return is determined in large part by when I sell. And if I have a bad circumstance that comes up and it happens that I suddenly need cash and the asset is down and I'm forced to sell, I'm missing out. So I don't want to be caught in that situation. To avoid being caught in that situation, what I'm doing is I'm saying, okay, instead of selling the asset, then even if it's down, I can borrow against it, right? So if I have a clear title property, I can go and leverage it for 50% all day long, almost not necessarily anywhere in the world, but in a wide range of parts of the world, very, very easily, okay? Getting financing, super cheap financing, and now what can I do? Now I can hold the asset through the period of time when it's recovering, and I can turn around, and if I need to sell it later when it's higher up, I can do so. So what am I going to do? I'm going to get this dividend participating. Let's talk about dividend participating whole life insurance policies and why they're significant. Okay, first of all, so there's a contractually guaranteed rate of return. This is a very good thing, right? This means that you're in a position where you have if it's issued in a country with strong regulatory environment, it's about as safe as a government bond, a federal government bond. Very, very safe, right? So your returns are pretty solid, pretty much guaranteed. Okay, so you've got that. That's good. Next, it is typically creditor protected, meaning if you get sued, they can't go after that life insurance policy. Number 3, it has a wrapper on it that it's typically treated separately for tax purposes. So generally speaking, you have favorable tax treatment. So for instance, if you were paying a 40% tax rate and this whole life insurance policy was paying, say, 5%, 5.5% return over time, which if you look at the tables over about a 100-year period, around 5.5% is about what you would expect for something like that, which is not an amazing return by any stretch, but it's not horrible, but it's also typically tax-free. So if you were to compare, if you had a fully taxed, say it's interest income, 9% would compare to 5.5%. So can you get something that pays 9% that has an equal degree of security, plus it has creditor protection, plus it's equally collateralizable, etc.? Probably not. Okay, so that's a really, really big thing. All right, what's the next situation here? The next situation to go along with it is, as I said, it's collateralizable. What this means is you can get something called a policy loan. You can do this without any obligation to repay, without need to qualify, and it's up to cash value. So there's some complexities. I'll maybe do a video in the future about dividend participation in whole life insurance policies, but basically the bottom line is you're treating it like a savings account. You're not going to have this be a large amount of your wealth, but up to 5% for somebody who has a fairly reasonably significant net worth, or if you're in you're built in a more building stage, I would say you should price it based on the amount that your capital expenditures are over about a 5 to 7 year period. So not including your house. So if you're buying a vehicle, if you're buying, basically how much money would you have to save up in order to buy that vehicle, and you're pricing the amount of contributions you would need to make into the policy into what your cash value will be over that period of time. And that's a whole other conversation that we can get into, but that's there. If you're buying a principal residence, the thing about this is, in this example, this is very easy money to get. However, for it to qualify as collateralizable, you need to be in a situation where you don't have debt against it, right? Otherwise, or at least very little, so that you have some margin that you can borrow against. Your objective here normally is to try and improve your cash flow. When your cash flow is sufficiently high and you have sufficiently large net worth, it doesn't matter so much. But ideally, the mistake that I see people make is they buy properties for too much, or they buy properties that are too big. So ideally you buy properties that it's comparable to something you would rent, and your rental amount would be higher than what you're paying in order to own it. And as a result, your cash flow is improving by owning it. Okay, that's kind of the basic logic there. Okay, now if you follow through, what have we got? We've got number 1, we've got no consumer credit, or no consumer debt. Number 2, we've got our cash reserve. Excellent. Number 3, we've got collateralizable assets. Now, interestingly, when you've done this, notice that what we've done is we've already diversified between 3/4 asset classes. And we've done this in a sequenced way that makes a lot of sense, right? So we have cash. This is an asset class, right? If you want to get crazy, you could diversify into multiple currencies, right? Number 2, we've got credit. This is in itself an asset, right? It's not considered an asset class in the normal sense. It is denominated in currency, so it goes along with the currency variation if you need to access it on short notice. And number 3, you have real estate, right? If you bought a principal residence. And number 4, you've got insurance. So you've got basically 4 asset classes. Now the insurance is kind of its own special treatment, but the truth is the funds are invested in public markets, right? Okay. Now at this stage, only at this stage, do you start saying, okay, now I'm going to look at putting my money into index funds. Now I'm going to look at putting my money into specific stocks. Now I'm going to do broader real estate investing. Now I'm going to invest in private equity, in venture capital, in angel investments, etc. And now at this point in time, what should your mindset be? Your mindset should basically be, okay, I'm going to look at the world and I'm going to say, where is the best opportunity? Okay. So I have a good friend who, he did this a few years ago, and he does very well, great investor. And he found Czech Republic and Vietnam were very attractive. So he bought property primarily in Czech Republic, did very well, right? So the point is, you can't know all the markets, but you can see, hey, where are the opportunities? And you can scope in and you can say, okay, right now, the best and opportunities are always going to be coming and going. They're going to be moving. They're not going to be in the same place. When crypto did very well in 2017, then it didn't do very well in 2018. So if you were in the same thing both times, you did well one year, you did poorly the next year, right? So you want to say, this year, right now, at the time when I'm allocating funds, where are the best opportunities? And you're going to invest there, okay? Now, the next year or the 6 months or whatever the time period is before your next allocation, because hopefully you have some cash flow coming in, etc. Then you're going to say again, okay, maybe last year I bought property in Prague, but is Prague still the best place to invest? And maybe you look and you say, oh, you know what? This year it seems like Vietnam is better. So now you're going to invest in Vietnam. Now, when you target in there, you're not looking for a specific market. The market is telling you where to do your research. So you're doing high-level research to identify, okay, what's the part of the world and the type of investment that represents the best opportunity now on a risk-weighted basis, right? Then I'm going to hone in specifically there. So once he decided, in this case, that, hey, listen, Czech Republic is the best place. Now he goes looking for deals in Czech Republic and he tries to find the best possible deal he can in the best possible market, right? So if you were going to have done cannabis, you say, okay, what was the best possible deal in the cannabis industry? And you went and you found that, right? Then you say, okay, what's the best possible deal in, I don't know, maybe the next thing is augmented reality or, delivery service companies, whatever it happens to be, right? But you find the best deal there. And then it changes and you say, okay, I'm going to go and look at this one. This allows you to protect yourself from ignorance by being highly educated about the place that you're placing money, but you're not necessarily living there. You're alternating from one to the other. You can't stay on top of all these, right? There's, 190 whatever countries in the world. There's so many different asset classes. You can't be an expert in all of them, but you can be an expert, at least to a reasonable degree, in this particular market at this particular time. Maybe you discover, London is great right now. Maybe you discover that Brisbane is great right now. Maybe you discover that Istanbul is great right now, whatever it is, right? And you're saying, okay, I'm going to invest there. And I'm not expecting that to be the place forever, but I've put my money there. Now I'm diversified into that area. I can leave it. It's an investment, right? Now I have some more capital come up. Say, I don't know, you're getting $1 million a year, whatever. You take that certain percentage, you allocate it to the next place. And doing this sequenced way, you will naturally end up with a very diversified portfolio if you're agnostic about currencies, about countries, about industries, asset classes, etc. And that's going to give you not only a pretty good chance of high success, but also very good protection, which will increase over time. Your portfolio will gradually become more diversified. And you can see kind of somebody like Warren Buffett has done something like this, right? He's diversified now between 70, 80 companies, but he's gotten there not by sitting down and saying, okay, I'm going to invest in 70 or 80 companies. Instead, he said, hey, I'm going to do 1 deal a year, 2 deals a year. I'm looking for the best deals this year. I'm going to buy that. Next year, I'm going to find the best deals that year. And maybe it's the same company. Maybe I'm going to double down on Apple. Maybe I'm going to double down on Coca-Cola, whatever it is. But whatever it is, you're going to pick it. So anyway, I hope that concept is helpful for you. If you're interested in some help, reach out to us. You can go and check out our websites, offshorecapitalist.com, offshorecitizen.net. You can book a call with me, clarity.fm/Michael Rosmer. Please like and subscribe to our channel. We really appreciate that. And check out some of our other videos. I will see you guys on the next video.